how I, as a tax strategist, now for north of 5 decades, tripled two school teachers, husband and wife, both school teachers, retirement income. Get ready. In this episode, I'm going to share this story when they came to me at age 59 and a half. And we ended up in less than 5 years tripling their retirement income rather than take their old advisors' advice. So get ready. I think you're going to be blown away with some opportunities maybe you didn't know existed before. They're called strategic rollouts, not a rollover. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 5 decades, helping thousands of Americans optimize their assets and minimize taxes and prepare for a comfortable retirement so they will not outlive their money. Now, I've helped hundreds of people perform what we call strategic rollouts. That's not a rollover. See, a rollover would be taking money that maybe you've accumulated in a 401k, rolling it over to an IRA to continue to defer, postpone, procrastinate paying tax until you have to start pulling out that money, which used to be at age 70 and a half. Now it's like age 72 to 73, where you have to start taking RMDs. That means required minimum distributions based upon your LE, your life expectancy. Basically, in a nutshell, if at age 73, your life expectancy is 20 years, you have to take out 1/20th of the value of your IRAs or 401ks in that year. And the next year, 1/19th, the next year, 1/18th. That's just a rough formula of what a required minimum distribution is, because the government wants that money out and taxed so they can receive their tax revenue. They've been planning on that tax revenue as the best savings bond they ever came up with for themselves. And so that's why they created these RMDs, required minimum distributions. Now, I think that's the worst advice for most Americans, and I will prove that in several episodes on my channel. This is one of them, and it's two humble school teachers that came to me years ago, and they were 59 and a half years old. And they had accumulated between the two of them, because they did have defined benefit pensions. Okay, they had a pension coming from teaching school for 30 plus years. And so you get 30 times 2% for every year of service. They got 60% of the average of their last 5 years' paychecks in a pension. On top of that, because they thought, well, we can't make it on just 60% of what we were earning. So they saved $250,000. Doesn't sound like a lot today, but you know, when they came to me a good 20, 25 years ago, that was a pretty good chunk. And it was in 401ks, 403bs, and a tax sheltered annuity, a TSA. Now, their advisor told them what most advisors did. Oh, if you don't need the money, keep deferring, putting it off. Procrastinate. Now, I say procrastinate because that usually doesn't turn out good when we procrastinate, right? But see, most advisors, even CPAs and tax attorneys say, well, if you don't need the money, you'll save tax by not withdrawing any money this year. Well, that's myopic, very short-sighted, okay? You're only saving tax in that given year. You're actually going to pay or increase the tax by continuing to defer. And I have proved that to thousands of retirees, okay? So I did that for these school teachers. Now, in a nutshell, I said, okay, let's say that you take your advisor's advice, and this $250,000, which you think is earning 7.2%, okay, which means the money will double in 10 years, because using rule of 72 math, if you're earning 7.2% return divided into 72, your money's going to double in 10 years, okay? So I did that. I said, so let's say you let this sit until you're age 70 and a half. So the $250,000 doubles to 500,000, okay? And now you take out RMDs, okay? Now, a required minimum distribution is usually less than 4%, but I'm going to use the 4% rule, which is the financial services industry standard. They don't want you to pull out more than 4% because the average retiree is only averaging 3.5% returns on their money invested in the market because of the ups and downs in the market, okay? So if these two school teachers had $500,000 at age 70.5, and they start taking out 4% a year because they have to, otherwise they'll be penalized 50%. That's what an RMD is. It's a required minimum that you have to pull out, or else you're going to be penalized 50%. And so 4% on 500,000 is how much money? Okay, it's 20 grand. Okay. So this is what their advisor said. Look, you can pull out $20,000 a year. And even though you're only averaging, about 3.5%, pulling out $20,000 a year or 4% is going to slowly deplete your $500,000 nest egg, but not before you both are expected to die. Okay. So that's what is called the 4% rule. So keep that in your mind. This is what their advisor said. Wait another 10 years and then start pulling out $20,000 a year. Now, $20,000, that's before tax. In their tax bracket, which was about 20% of the time, even if they held that tax bracket, you're not netting $20,000, so you're only netting $16,000 to buy gas, groceries, prescriptions, and golf green fees. But let's go ahead and use the gross income of $20,000. Now, I tripled their income. I actually did even more than that, but I'm going to be very conservative as I share with you what I did. So I showed them a strategic rollout. That's not a rollover. I said, let's get the money out, the taxes over and done with sooner than later. Now, of course, they reacted like most people. Oh, we don't want to pay the tax. I said, you're not saving tax by continuing to postpone and defer, okay? You remember the old Framwin Autolite commercial? If you don't remember that years ago, there was an automobile mechanic that would come on TV and he would say, you can either pay me now and I'll change your oil filter. He would hold up an oil filter. Or you can wait and pay me later and I'll replace your engine. You wouldn't believe how many people would opt to do that. And so it's way better to get the taxes over and done with and then reposition that after-tax money into something that's going to be tax-free from now on at a much higher rate of return and end up reimbursing you for any tax that you would pay. So stay with me here. I said, okay, here's the first strategy. I would recommend that we do a strategic rollout. You will not move into a higher tax bracket, even if we pull out $60,000 a year out of this $250,000. Now you're earning 7.2%, so it's going to actually grow some more while we're getting it out of there, and so we'll end up having about $300,000 that we get out over a 5-year period. 5 divided into 300,000 is 60 grand a year, okay? So that's called a strategic rollout. We pull out 60,000 a year. That shows up on the front page of their 1040 tax return. But in their tax bracket, they only needed to pay 12,000 in tax. Now, of course, at first they went, oh, we don't want to have to pay 12,000. Well, you're going to pay it sooner or more later. Okay. So they finally felt good about that. And I said, what would you rather do? Get this over and done with and pay 60,000 over 5 years in tax, or wait and pay $250,000? Because taking RMDs out to their life expectancy, they were flabbergasted. I added up all the tax. They were going to pay over $250,000 in taxes by deferring 10 more years, having their money double to $500,000, and then pay tax on RMDs the rest of his life and her life, and then the children. And it was at least $250,000. And they went, wow, we've never done the math. Yeah, they were going to pay as much in tax as they actually had in the account at age 59 and a half. So they got it. And they said, oh yeah, well, let's just pay $60,000 in tax in the next 5 years. instead of waiting and paying $250,000 in tax. You're right. We're not saving tax doing RMDs. We're compounding the tax. Yep. And so they were ready to do that. And the wife said, well, is that what you would do, Mr. Andrew? And I said, well, in looking at your finances here, you own some rental properties. And you've been sending extra principal payments to the mortgage company, trying to get out of debt. Well, yeah, we just have positive cash flow. And so, yeah. Well, actually, we could resurrect some of those deductions that you've been killing by paying down those mortgages, because those properties are worth more now. And you could refinance one or two of those, and that would resurrect enough tax deductions that would offset the $12,000 of annual tax on this $60,000 of withdrawal, because we're going to wash away that with these mortgage interest on these two rentals. I don't care if it's 3 or 4 rentals. They went, wow, okay. And so they asked me to show what if I did it on one of the rentals and the tax went from $60,000 down to $20,000. They said, well, okay, so what if we refinance this other rental? Well, then we totally wiped out the tax. They said, let's do that. And then at the end of 5 years, we can come in and we can pay off those mortgages, because now we'll have the money to pay them off the smart way. I said, absolutely right. So this is what they did. Let me summarize thus far. So in 5 years, we took out $60,000 a year, which showed up on the front page of their 1040 tax return, but it was washed away when they itemized the deductions on either their Schedule E for their rental properties or their LLCs or wherever, okay? So they washed out the taxable income of $60,000 coming out of their 401ks and 403bs, okay? So we got the money out subject to tax, but we wiped away the tax by resurrecting deductions they'd been killing by paying down their rental properties, okay? So at the end of 5 years, instead of paying $60,000 in tax, we paid 0. And so I was able to get all $300,000 into their IUL. Whereas before we were only going to get maybe $240,000 in their IUL because they were going to pay $60,000 in tax. So at the end of 5 years, we have $300,000 now in their IUL policies. So far, so good. Now, they didn't need that money yet. They weren't going to plan on retiring for another 5 or 6 years. And so that $300,000 ended up growing to $500,000, actually $600,000. And so by the time they started taking money out, which was at age 72, they didn't have to start taking it out at age 70 and a half when it's in an IUL, because they've already got it all out, right? So they ended up with $600,000 in their IULs, and they get a 10% payout. Yep. Most of my clients are able to get a 10% payout without depleting principal. So 10% on $600,000 is $60,000 a year, tax-free. I don't care if they only got out $48,000 tax-free. That would be better than the after-tax income that they were getting out of their IRAs or 401ks. They were going to pull out the RMD of $20,000 and only net $16,000. Okay, $48,000 is 3 times that. So I could have gotten an 8% payout and tripled their income. But talking about gross to gross, I was able to get them $60,000 a year of tax-free income compared to $20,000 of taxable income out of their IRAs or 401ks if they followed their advisor's advice. Okay? Now, that's tripling their income. It was amazing, but that's not the rest of the story. They said, okay, well, let's go ahead and take the money out of the IUL that we also deposited in there from refinancing the rental properties. I said, okay. And I went to pick up the phone to do that. And they said, well, hold on. Is that what you would do? I said, no, that's not what I would do. And they go, well, remind us why. I said, well, see, you're paying only this much interest on those mortgages. You borrowed that money at 6% tax deductible interest. That's a net cost of 4, and you're earning 8 to 10. How much more is 8 than 4? Don't say 4. It's 100% more. You're earning double what the interest is costing you. Would you fire an employee that is costing you $40,000 a year when that employee is making you $80,000, twice what they're costing you? Why would you fire an employee? That's in essence what you'd be doing by paying off your rentals. That's what I don't. I keep my rentals mortgaged to the hill and I double dip. They go, that's brilliant. I said, see, it doesn't matter if my rentals are vacant. If my rentals are vacant, I still make twice as much as I'm paying in mortgage interest, even if I have 0 rental income. Most people don't understand how to do that. And when they have vacancies, they're sweating bullets because they can't afford even the mortgage payment. They said, this is brilliant. And so they continue to earn 100% more than the cost of the mortgages, which I won't even tell you that number because it was greater than they were getting from what I generated out of their IULs from their IRA 401ks. They said, Doug, we're making so much money, we don't know what to do with all this money. Those are the nice kind of problems I like to create. So that's a story of how I helped 2 school teachers triple their income. And I've only been talking about from what their advisor was going to generate out of deferring their IRAs and 401ks, the 403Bs rather, and the TSAs to age 70 and a half, and then taking RMDs. I tripled their income by getting the money out, the tax is over and done with, a strategic rollout, and repositioned into IULs. 60,000 of tax-free income versus 20,000 of before tax income out of their IRAs. But the bonus, the icing on the cake, they were earning 100% more than the cost of their mortgages on their rentals. And that generated positive cash flow, regardless of whether those rentals had tenants or if they were vacant. If you are gaining insights into opportunities, please subscribe to this channel, but I would like you to subscribe to an IUL laser fund. I want you to claim a free copy of my most recent best-selling book. Now, this has been flying off of my warehouse shelves. It retails on Amazon for $20 up to $60. And if you buy it on Amazon, thank you, but I'll gift you a copy for free. You simply go to laserfund, laserfund.com, or click on the link below, and you contribute a nominal amount towards the shipping and handling. I require a little skin in the game, but I will pay for the book. I will fire out a hard copy to you via priority mail. And while you're in there claiming this free hard copy, if you like to listen and learn or watch and learn, there's those formats available for your investment. You can register for a free educational webinar that we teach every week, no cost, no obligation. To learn more, you can even schedule an appointment with an IUL professional to see how a properly structured max-funded IUL, what I call a laser fund, may look like in your particular set of circumstances, because it's imperative you get it done right. But begin by claiming your free copy of this book, which is actually 2 books. This side, about 200 pages, is all the charts and graphs and explanations if you're a left brain learner. If you're a right brain learner, you learn more by stories and examples. You flip it over to this one. This is about 100 pages, 12 chapters with 62 actual client stories. And if you want to use your right brain and your left brain, then you can read the entire book. So this is about you and your brighter future. I can show you opportunities that you probably never knew existed before. And watch my other episodes of how I, as a tax strategist, have helped people double, triple, quadruple their income over their IRAs and 401ks.